What's up, Trader's Edge? It's Mark Sebastian, your only option. And today we're here to talk about what happened during the week. Notably, we're going to dig into the action from Thursday and Friday and what caused that. And then I'll talk to you about what could happen on Monday and Tuesday. So, with that, let's dig in. All right, so on Friday, the S&P 500 touched the 100-day moving average. It did bounce off that level, but gapped lower. It's at month lows. It's at levels we've not seen since June 11th. Interestingly, its closing price closes the gap from June 11th. Look at this. June 11th, the high close was 53.75. So we've actually are now below, and the high was literally right there. So we've literally closed this gap, and then got all the way down to the 100-day moving average. Actually, briefly threatened to break 5,300, but did not. But markets took notice. Up until now, I want to show you the VIX. Up until Friday, the VIX had been kind of swelling slowly higher, right? Starting July 10th, notably my sister's birthday, vol had started to creep higher, but never exploded until Friday. Friday, we saw the VIX get all the way up to 29.66, closed 23.39. But what's interesting is that vol futures did not give away this big move like the VIX did. And let's take a look at the futures term structure. We're now in backwardation. What is backwardation? Backwardation is when the VIX, this green line, is trading above the front month future, which is trading above the second month future, which is trading above the third month future, fourth month, and fifth month. Now, the third month has this weird little kink because of the election. So it's staying a little bit higher. But if there wasn't an election, October futures would be around 21.5, somewhere in that range. So I'm going to ignore that kink and tell you that all the way up to December, we are in backwardation. So what does that mean? Well, let's think about the last time we first entered a serious leg of backwardation. And that is going to take us all the way back to March of 2020. So here we are, March 2nd. Actually, I'm actually going to start with February 26th. All right. So here we are, February 21st. COVID is just starting. And you can see the curve is really flat. By February 25th, 2020, you can see we're in huge backwardation. But that was just the beginning. It wasn't the end. You know, pulling up my 5-year chart and then honing in on what happened here. Here's February 24th, when we got in the 20s, 25th. But you can see we went all the way up. Now, does that mean that's what's going to happen here? No. Doesn't mean that. But this was not just a VIX spike. This has been building for several weeks. You could see the writing on the wall. And that, to me, is huge. That tells me that, hey, maybe this isn't just a 1, 2, 3 day event. And then you look at VVIX. This is the cost of VIX options. It got as high as 160, closed 130. That is the highest level we've seen in VVIX in over 2 years. If we go back to 5 years, the last time we saw this kind of action was in 2022. So vol is really, really juicy. Demand for options. And so what's happened? People got caught really flat-footed, I believe. Nobody believed that the S&P could actually sell off, that the Great Eight could actually sell off and have any meaningful selling. Well, we ended up with our first touch of the 100-day moving average since all the way back in November. And now people are scrambling. The word of the week at the OptionPick conference in Chicago was convexity, and convexity paid. So what do I mean by that? On Friday during trade to close, I laid out an option. It was a put. It was the 5100 put in the S&P 500. It cost $3.30. That was Thursday night. On Friday morning, I sold that same put at $18. And that is because what happened was not just a drop, but look at the move implied volatility made. It was just massive. But even with this big move that implied volatility is made, realized volatility, how much we're actually moving, is still eclipsing implied. That tells me we're not done yet. So what do? Well, a couple things. One, hedge. Two, now's the time to start thinking about what stocks do you want to own and what level. So, for instance, name like Intel got blown up on Friday. Turn back to the stock chart here. Got blown up on Friday. This is one that I actually bought stock in on Friday. Or a name like Qualcomm. A little different story. Intel's only $20. I'd rather just buy the stock. Qualcomm, vol's really high. Stock's 159. Let's say I want to own Qualcomm under $150, which I do. The October 150 puts are like $8. That's pretty good premium. If we turn around the other way, I'm going to keep the $8. If we drop, I own Qualcomm for 142. I love Qualcomm at 130, loved at 150, loved at 175. I sold out of my Qualcomm, my long position around 210. I'm now looking to get back in. So there are some spots here where there's some strategic opportunity. But where is there real risk? Take a look at MGK. This is the mega cap ETF. This thing is getting obliterated. It is actually below its 100-day and might hit the 150, maybe even the 200. The weakness is in the mega caps. The weakness is in the mega caps. So that being said, I love the vol pop, not just because I had convexity. Convexity means that I have exposure to volatility exploding and the market dropping. It's not just that. It's that I am prepping for a trade in VXX. VXX split into this rally. VXX split 4 for 1. Prior to the rally, it was $11. Split adjusted, it would be about, call it 17. But with the split, it's all the way, it reached as high as 65 and it's trading $63. The higher, this thing is like an elevator with broken emergency brakes. It's going to go up, 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 up until it doesn't. And when it falls, those emergency brakes are not going to be there, and it is going to fall through the floor. I'm building a VXX trade as soon as our mathematical models tell me it's time to go short this thing. We have a couple of major mathematical spreadsheets that we are watching that tell us when to go short VXX. This is one that when I go short, I'm going to go hard in, probably going to put about $15,000 into it, and I'm expecting at a minimum 100% on my trade. You want to join me in that VXX trade? Click the link in this email. You're watching me on YouTube. It's in the comments. You're watching on YouTube. Please like and subscribe. So what's happened over the last few days mean for Monday? Well, could we turn around? We get some sort of emergency thing over the weekend, maybe. But we do set up for the bad Thursday, worse Friday, crash Monday. That's what's happened with every major market crash. Black Monday, 2002, 1997, 2020, 2008. Every single major, like we wake up and it's like, oh my gosh, we're limit down, happens on a Monday. Why? We sell off Thursday. People are like, it's fine. We sell off big on Friday. People get worried. They read headlines over the weekend. They tell their broker to sell. Markets tank. Downside of the market, next stop, we break 5307 on the 100-day. We could drop all the way to 5100, 5177. Then from there, we'd be looking at 5,000. This has been a violent rally up. Violent rally ups. The only thing more violent than a rally up is a sell-off, and we are set up for that. Once again, I want you to join me in prepping for this VXX trade. Once we put it on, I'm going to, like I said, I'm putting in 15 grand, and I'm looking for at least 100%. Sign up here. And if you're on YouTube, like and subscribe, and leave me a comment or a question, and I'll make sure to get it in my next video. All right, folks, I'm Mark Sebastian, your only option. I hope you have a great weekend.